In October 1907, the United States experienced a banking panic that threatened to collapse the entire financial system. Banks stopped lending, depositors formed lines, stock prices plunged. The man who stopped it, who organized the banks, provided liquidity, and stabilized the system, was J.P. Morgan. He was called a hero. What was not reported at the time, and what historians have since documented, is that Morgan's own network had triggered the panic, and the political outcome of his rescue was exactly what Morgan had been lobbying for: a central bank.
J.P. Morgan in 1907 controlled approximately 40% of U.S. industrial capacity. U.S. Steel, General Electric, AT&T, dozens of other major corporations were funded through or connected to his banking network. For 20 years, he and other major bankers had been pushing Congress to create a central bank, a lender of last resort. Congress had repeatedly refused. The Panic of 1907 changed that.
The immediate trigger was a failed attempt to corner the copper market by Augustus Heinze and Charles Morse, both of whom had banking relationships that made their failure contagious. But historians, including Charles Geist and Ron Chernow, have documented that Morgan's associates had been aware of the Heinze-Morse speculation for months, had done nothing to stop it, and in some cases had facilitated it. The panic that resulted gave Morgan the platform he needed.
Morgan convened the senior bankers of New York in his personal library, a room filled with priceless art and manuscripts. Over several sessions, he organized the response, coordinated lending, deposit guarantees, liquidity injections. The public narrative was unanimous. Morgan had saved America. Congress, watching a private citizen manage what should have been a public function, began to seriously discuss a central bank for the first time.
In November 1910, several of Morgan's closest associates traveled to Jekyll Island, Georgia, Morgan's private resort, to draft legislation for a central banking system. The meeting was held in total secrecy, participants using first names only. The legislation they drafted became, almost word for word, the Federal Reserve Act of 1913. The Federal Reserve was structured to give private banks, including Morgan's network, controlling influence over monetary policy.
J.P. Morgan died in March 1913, 9 months before the Federal Reserve Act was signed. He did not live to see the institution he had spent his career engineering, but his partners did. The Federal Reserve Bank of New York, the most operationally powerful of the 12 regional banks, has Morgan's fingerprints on its founding structure. The private shareholders of the New York Fed were and remain the largest commercial banks in the country.
The pattern of the 1907 panic has been called the Morgan template. A financial crisis creates demand for systemic reform. The entities that caused or benefited from the crisis have the most access to shape what that reform looks like. The resulting institution serves their interests. This template repeated in 1913, in 1933, in 1989, and in 2008. It will repeat again. The question is what form the next institution takes and who writes its charter. Subscribe.